What does it look like when a wealth management firm, built on handshakes and advisor loyalty, breaks its own revenue record, not during a bull market peak, but in the middle of a tariff-driven sell-off?
It looks like $3.86 billion is in a single quarter, up 13% year over year. Net new assets up 160%. And for the first time in the firm's history, fee-based assets in the private client group crossing $1 trillion.
Raymond James Financial just reported fiscal second quarter 2026 results. Adjusted earnings per share of $2.83, beating the estimate of $2.76 by 7 cents. Adjusted return on tangible common equity of 20.9%, squarely inside management's long-term target range of 19 to 23%. And the firm closed 2 acquisitions in 90 days.
The stock is $154.52. At 12.5 times forward earnings, Raymond James is trading at a meaningful discount to LPL Financial at 29 times and Stifel at 20 times. 12 analysts cover the name, 3 buys, 0 sells.
We are going deep on Raymond James Financial today, ticker RJF, the St. Petersburg, Florida wealth management and capital markets firm that has quietly built one of the most defensible advisor retention moats in the industry. Let's get into it. Raymond James Financial is organized around 5 operating segments. The core engine is the Private Client Group, PCG, which accounts for roughly 73% of consolidated net revenues. PCG serves clients through approximately 8,900 financial advisors offering investment advisory, financial planning, brokerage, and insurance products. The second segment is Capital Markets, which handles investment banking, equity and debt underwriting, M&A advisory, and institutional brokerage. Third is Asset Management, delivering portfolio management services to retail and institutional clients. Fourth is Raymond James Bank, providing securities-based loans, commercial real estate lending, and mortgages funded by client deposits swept from advisor accounts. The fifth segment handles corporate functions and eliminations.
What makes the business model distinctive is how the segments interconnect. When an advisor joins Raymond James, their clients move with them. Assets flow into PCG accounts, fee-based revenue is generated, cash balances sweep into Raymond James Bank, generating net interest income, and the asset management arm captures additional fee revenue. Every new advisor is a compounding revenue engine across 3 segments simultaneously.
The company has approximately 19,500 employees and operates primarily in the United States, with additional operations in Canada and Europe. The headquarters is in St. Petersburg, Florida, a detail that matters because the firm has built a distinctly different culture from the Wall Street wirehouses. It is not Morgan Stanley or Merrill Lynch. It is designed not to be.
The reason that matters is the moat. Raymond James's advisor ownership model is written into contracts. Advisors own their client books. When an advisor leaves, the clients belong to the advisor, not Raymond James. That is the opposite of the wirehouse model, where the institution pursues clients when an advisor departs. Because Raymond James can't hold clients hostage, it has to compete on service, culture, and tools, and the data suggests it is winning on all 3. The J.D. Power 2025 Investor Satisfaction Survey ranked Raymond James number 1 for advised clients, and 93% of its advisors expect to still be at the firm in 2 years, the highest of any major firm measured.
And the $1 trillion in PCG fee-based assets is the output of that model. You build it one advisor relationship at a time, and then you let compounding do the rest. Paul Shoukry became president and CEO of Raymond James in 2023, following 4 years as chief financial officer. He joined the firm in 2005 as an investment banking analyst, rose to lead the investment banking group, and was then named CFO during a critical period of balance sheet expansion when Raymond James Bank was scaling securities-based lending and commercial real estate. He holds a finance degree from the University of Florida. He is 47 years old.
His CFO background matters here because the levers that move Raymond James's earnings are largely financial: sweep to deposit pricing, securities-based loan yields, buyback timing, and comp ratio management. Shoukry knows where every margin dollar comes from. The December 2025 announcement of a $2 billion share repurchase authorization and an 8% dividend increase, while peers were hedging on capital return, was a deliberate signal of confidence in the earnings trajectory.
The moment from Q2 FY2026 that defined his tenure philosophy was the RAI announcement. RAI is a proprietary AI operations agent that was writing 3.2 million lines of code per month by the time of the earnings call, automating back-office functions, compliance workflows, and advisor support operations. And in the same call, he said, "Personal relationships will always trump any tech or bot." He is positioning AI as a productivity multiplier, not a headcount replacement. For a firm whose value proposition is the human-advisor relationship, that is the only framing that preserves the moat.
Analysts credit him with returning Raymond James to aggressive capital markets mode while keeping the culture intact. That is not an easy balance to maintain at $30 billion in market cap. Let me walk through the financial picture on Raymond James. The stock is trading at $154.52, giving the company a market capitalization of approximately $30.45 billion. The 52-week high was $177.66 and the low was $131.85. Beta is 1.01. This is almost a perfect market mirror. When the S&P moves, Raymond James moves with it. No more, no less.
And the valuation multiples.
Price to earnings on a trailing basis is 15.1 times, on a forward basis 12.5 times. Price to sales is 2.1 times. Price to book is 2.4 times, based on book value per share of $64.58. Those are the numbers you compare to peers, and we'll do that in a few minutes because the comparison is instructive. On the top line, net revenues for the fiscal second quarter of 2026 were $3.859 billion, up 13% year over year and a company record. The revenue estimate was $3.850 billion, beat by $9 million. Revenue TTM is 14.22, with the firm guiding to approximately $15.88 billion in full year FY 2026 consensus.
And the earnings per share?
Adjusted EPS of $2.83 for the fiscal second quarter of 2026 versus the estimate of $2.76, a beat of 7 cents, or approximately 2.5%. Trailing 12-month EPS is $10.22. For a financial services company, the margin structure is different from a manufacturer. Gross margin is effectively 100% since net revenues are already net of commissions and trading costs. What matters operationally is the compensation ratio, 65.8% of net revenues in Q2, up from 64.8% a year ago. Recruiting spend was $111 million, up 25%, as Raymond James accelerated advisor hiring. The adjusted pre-tax margin is 19.7%, and the adjusted return on tangible common equity is 20.9%, inside the long-term 19 to 23% target.
And net new assets, the organic growth rate.
This was the headline number. Net new assets in Q2 FY 2026 were $23 billion, up 160% from $8.9 billion in Q2 FY 2025. Annualized, that is 5.8% of beginning client assets. For a wealth management firm, that is the equivalent of a tech company reporting user growth. PCG fee-based assets crossed $1 trillion for the first time in company history. PCG client assets total approximately $1.6 trillion across all account types.
The cash and balance sheet picture?
Raymond James Bank reported Q2 net revenues of $486 million, with a net interest margin of 2.81%, declining modestly from prior quarters as client cash balances normalize post-rate cycle. Total balance sheet assets of $88.2 billion include substantial client sweep deposits. Stockholders' equity is $12.57 billion. Book value per share of $64.58, growing at a mid to high single-digit rate. Free cash flow TTM is $1.4 billion. The firm returned approximately $400 million in buybacks in Q2, and $1.6 billion is in the trailing 12 months. $1.5 billion remains on the current $2 billion authorization, and the annual dividend of 2.6 cents per share, yield of 1.4%, represents a 21% payout ratio with an 8% 5-year growth rate. Overall, Raymond James's financial health is strong. Record revenues, expanding fee-based AUM, buyback execution, and ROTC inside the long-term target range with growing capital return capacity.
The analyst picture on Raymond James is broadly constructive but cautious. 12 analysts cover the stock. 3 have buy-equivalent ratings, 9 are holds, and 0 are sells. The average price target is $177. implying approximately 14.5% upside from the current 150.52. The range runs from $145 on the low end to $196 on the high end.
The loan named buy is Barclays, maintaining an overweight rating with a $174 price target, cut from $196 on April 8th following broad tariff-driven market uncertainty. The Barclays thesis is the advisor recruitment momentum and fee-based AUM compounding story being underappreciated at 12.5 times forward earnings relative to peers.
Morgan Stanley takes the most cautious view among named analysts. Michael Cypress maintains a hold rating with a $171 price target, cut from $187 on April 10th. The concern is RJBDP sweep income. When short-term rates fall, the interest Raymond James earns on client cash swept into its bank deposit program falls with them, and that is a direct hit to earnings with no easy offset.
TD Cowen went the other direction in January. Bill Katz raised his target from $180 to $187 on January 14th, citing the $2 billion buyback authorization and NNA growth trajectory as positive re-rating catalysts. TD Cowen is a hold, but a more constructive hold than Morgan Stanley.
The Q2 FY2026 results moved the stock. After hours, RJF rose approximately 4 to 5% on the combination of the EPS beat, the $23 billion NNA, and the $1 trillion milestone. Not a full re-rating, but directionally right for a name that had traded down 13% from its 52-week high heading into the print. The bull case starts with compounding. PCG fee-based assets just crossed $1 trillion. At 5.8% annualized organic growth and even modest market appreciation, that base compounds every single quarter. Fee-based AUM drives asset management revenue, which drives pre-tax margin, which drives EPS, and the engine accelerates with scale. Raymond James does not need markets to go up to grow earnings. It needs advisors to keep bringing in new clients, and the data says they are.
The bull adds the valuation argument. At 12.5 times forward earnings, Raymond James is priced at less than half the forward multiple of LPL Financial and at a 37% discount to Stifel. If the adjusted pre-tax margin reaches 20 to 21% and NNA stays above 5% annualized, the earnings trajectory argues for a higher multiple, and a $1.5 billion remaining buyback accelerates EPS growth independent of operating results.
The bear case starts with interest rates. Raymond James earns meaningful net interest income from the RJBDP sweep program. Client cash swept into the bank at rates that depend on the short-term rate environment. When rates fall, that income falls with them, and there is no hedge. PCG pre-tax income actually fell 3% year over year in Q2 despite record revenues, entirely because interest-related revenues declined. If the Fed cuts aggressively, sweep income compresses, and the EPS growth story looks much flatter than the AUM numbers suggest.
The second bear argument is the compensation ratio. At 65.8% of net revenues and rising, recruiting costs are accelerating. Raymond James spent $111 million on recruiting in Q2 alone, up 25% year over year. Advisors coming over from large wirehouses need transition packages, forgivable loans, and technology onboarding. If revenue growth decelerates while retention and recruiting costs stay elevated, the path to the 20+% pre-tax margin target gets significantly harder. And the bear notes that Raymond James no longer reports quarterly advisor headcount, making it harder to independently verify whether recruiting momentum is as strong as management describes.
The third bear argument is capital markets cyclicality. Investment banking revenues were up 29% year over year in Q2, and the pipeline is strong, but IB revenues are inherently lumpy. Any slowdown in M&A activity or equity underwriting would hit this segment at high operating leverage, and RJF does not have the fixed income trading buffer that the large investment banks use to smooth that volatility. The closest comparable to Raymond James is Ameriprise Financial, ticker AMP. Ameriprise is a pure-play wealth management firm with a similar advisor retention culture and a diversified product mix. AMP trades at approximately 12.7 times trailing earnings, broadly in line with Raymond James's 15.1 times, and posted adjusted EPS of $10.83 in Q1 2026, beating estimates. Ameriprise's $42.8 billion market cap gives it a 40% size premium over RJF, reflecting its higher proportion of fee-based AUM relative to transactional business.
LPL Financial, LPLA, is the largest independent broker-dealer by advisor headcount, with over 32,000 advisors and $2.4 trillion in assets under advisement. LPL trades at 28.9 times trailing earnings, more than double Raymond James's multiple. That premium reflects its independent-only model and rapid advisor count growth. But LPL's recent acquisition of Commonwealth Financial Network created integration disruption, and Raymond James publicly reported picking up advisors departing Commonwealth during the LPL transition, a reminder that M&A at scale can hand advisors and their assets to rivals.
Stifel Financial, ticker SF, is the most direct capital markets comp, similar wealth plus investment banking mix. Stifel reported Q1 2026 revenue of $1.48 billion, up 17.7% year-over-year, with adjusted ROTs of 24.8%, above Raymond James's current 20.9%. Stifel trades at 20 times trailing earnings, a 32% premium to Raymond James's 15 times. The Stifel premium reflects stronger capital markets revenue mix and faster percentage growth from a smaller base.
The valuation summary: Raymond James at $30.45 billion sits between Ameriprise at $42.8 billion and LPL at $25.2 billion in market cap, trading at the lowest forward multiple of the three. Whether that discount is a value opportunity or a structural feature of the rate-sensitive balance sheet is the central question. Options data for Raymond James is limited. With a beta of 1.01 and a shareholder base dominated by institutional holders, RJF is not a high-volume options name. Retail options activity in large-cap financial services stocks is typically minimal. This is not a meme stock or a high-volatility tech name. Implied volatility percentile is approximately 35%, below its 12-month average, and the broader options sentiment is neutral.
That low IV environment reflects the nature of the stock. Raymond James earns predictable, fee-based recurring revenues that compound quarterly. The primary binary risks, a rate shock or a dramatic market sell-off, are macro events that would affect the entire financial sector, not Raymond James specifically. For institutional holders managing large equity positions in RJF, options are used for hedging rather than directional speculation.
The practical implication for the earnings catalyst: a 2.5% beat on adjusted EPS in a low IV environment generated a 4 to 5% after-hours move. That is consistent with a stock where the options market was already pricing in a tight earnings range, and the actual result came in at the top of that range. No surprises, no dislocations.
The insider picture at Raymond James is quiet. No open market purchases in the past 6 months from any officer or director. CEO Paul Shoukry has had no insider transactions on record for over 18 months. The notable transaction is from Chief Administrative Officer Bella Leuchter-Allaire, who sold approximately 29,551 shares at $142.34 per share on March 19, 2026, roughly $4.2 million.
Context matters here. The CAO's sale occurred at $142 per share, below the current stock price of $154. That is not a sale at the top. It is a routine diversification from equity compensation by an executive managing a large equity award. RSU vesting and associated tax withholding sales make up the balance of recent transactions. The CEO's 18-month absence from the insider transaction record is neutral. At a company generating over $1 billion in annual net income, executives are managing equity compensation through planned processes, not making opportunistic market calls.
Still, zero open market buying at a stock that is down 13% from its 52-week high is a data point. If insiders had strong conviction that $154 is deeply discounted, you would expect to see some purchasing. The absence is not disqualifying. It is simply consistent with a large-cap company where personal wealth diversification drives most insider transaction activity. The top risk to monitor is interest rate sensitivity. Raymond James Bank earns net interest income from two primary sources: client cash swept into the RJBDP program and securities-based loans. Both are tied to short-term rates. The bank NEM of 2.81% is already declining, and PCG pre-tax income fell 3% year-over-year despite record AUM, entirely because of lower interest-related revenue. Watch the Fed funds rate trajectory. Every 25 basis point cut is a material headwind to Raymond James Bank's earnings.
Second, the compensation ratio trajectory. At 65.8% of net revenues in Q2, recruiting expenses of $111 million, and a 25% year-over-year increase in those costs, the compensation ratio is moving in the wrong direction for margin expansion. Management's target is to reach 20+% adjusted pre-tax margins. At a 65.8% comp ratio, that requires either accelerating revenue growth or moderating recruiting spend. Watch the comp ratio in Q3.
Third, capital markets cyclicality. Investment banking revenues of $272 million in Q2 are recovering from prior year troughs, but the pipeline can turn quickly. M&A activity is sensitive to rate expectations, equity market volatility, and regulatory environment. Any meaningful slowdown in deal activity would hit Raymond James's IB segment with operating leverage, and there is no buffer in the model equivalent to fixed income trading at the large banks.
And fourth, advisor headcount transparency. Raymond James discontinued quarterly advisor headcount reporting. At 8,900 advisors, the recruiting story is the core of the organic growth narrative, but without headcount data, investors are relying on management's characterization of momentum rather than independently verifiable numbers. Watch for any color management provides on advisor additions and departures in quarterly calls.
So where does this leave us on Raymond James after Q2 FY2026?
Operationally, this was a record quarter. Revenue up 13% to $3.86 billion. Adjusted EPS of $2.83 beating the estimate. Adjusted ROTC of 20.9% within the 19 to 23% long-term target. Net new assets of $23 billion, up 160%. And PCG fee-based assets crossing $1 trillion for the first time. 2 acquisitions closed in 90 days. The company is executing across every measurable dimension.
The stock is $154.52. The average price target is 177s, implying 14.5% upside. 3 buys, 9 holds, 0 sells. At 12.5 times forward earnings, Raymond James trades at a steep discount to LPL at 29 times and Stifel at 20 times. $1.5 billion in buyback authorization remaining provides a direct earnings per share tailwind independent of market levels.
The number to watch is net new assets as a percentage of beginning client assets. Q2's 5.8% annualized rate is the highest organic growth reading in years. If that rate sustains above 5% while fee-based AUM compounds, the earnings trajectory justifies a multiple re-rating. If rate cuts pressure RJBDP income while the comp ratio stays elevated, the 12.5 times forward multiple starts to look less like a discount and more like a ceiling.
The case for Raymond James is fundamentally a case about moat durability. The advisor ownership model is not easily replicated. The J.D. Power #1 ranking and 93% 2-year retention intention are outputs of a culture that took decades to build and that the wirehouses cannot simply copy. If that moat holds and the fee-based compounding story continues, the valuation discount is an opportunity. The market is pricing in more risk than the business results suggest. We will leave you with this from Paul Shoukry on the Q2 FY2026 earnings call. Personal relationships will always trump any tech or bot, but AI tools like RAI free our advisors to focus on what truly matters to clients. Combined with record net revenues and the strongest recruiting momentum in our history, I believe we are building on a position of strength that is unique in this industry.
Personal relationships will always trump any tech or bot. From the CEO who just launched an AI agent writing 3.2 million lines of code a month. The tension in that statement is the whole Raymond James story, building the most sophisticated tools in wealth management while betting that the human-advisor relationship is the thing that cannot be automated away.
That's going to do it for this episode of Charged Alpha, your S&P 500 stock encyclopedia. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.